we'll have a $20 million fund, and then we'll go raise like a bunch when we launch, and we'll have 5 or 6 or 7 million with trickle in. And then we'll start using that. We'll start buying properties. And then it's like, okay, we're getting kind of low. Better put on the gas again. And then we'll go and I'll talk about it on my Instagram and on my podcast. And all of a sudden more money comes in.
Guys and gals, my name is Jess Vergelli, and you're listening to Working Capital, the real estate podcast. We have a returning guest on the show, Brandon Turner. He was our first guest ever on the podcast. Brandon holds a lot of titles. He's an investor. He's one of those VPs at BiggerPockets. And most recently, he is about to release the Multifamily Millionaire. And Brandon, correct me if I'm wrong, that's volume 1 and volume 2.
That is correct. That's all. That's a great introduction, man. Look, well done. Well done.
I appreciate it, man. Well, it's good to talk to you. It's crazy to think that, oh man, what has it been? It's almost 70 episodes now. So a year and
year and change.
A year and change. Quite some time. You know, nothing's really happened in the world over the last year and a half. So.
No, it's been a pretty lame couple of years here. Nothing's happened in the world. So nothing really to talk about today.
Yeah, real quiet. Well, yeah. Listen. Thank you as always for giving your time here. I know it's always nice to talk to you, catch up, see what's going on in your world, and talk real estate. So maybe on that note, it has been a year and change. How's everything been going with you? I guess first and foremost, you, the family, everybody's all good.
Yeah, it's been a weird year. I mean, Hawaii was like it would like you go to the beach. I live in Maui for those who didn't know that, but I go to the beach and it was like empty. Like you'd be the only one on the beach. And we went from that to now you go to the beach and there's people sitting on you like everywhere you go. So like it was such a stark, drastic change. So yeah, life has been weird. Real estate stuff has been nuts. I don't remember exactly what I had when I was on last time, but in the last 18 months, roughly, we've picked up, what is it, like 10 or 12 large mobile home parks. We have about 1,700 units now that we bought in the last year. We have another 1,800 under contract right now. So we'll be at 3,500 by the end of this year, which has been crazy. Yeah, I went from 0 employees to I think 13 now. So it's been a growth year and a half. Which
I love the picked up. Just picked up. I'm gonna pick up some milk after this.
Yeah, we're gonna pick up some milk and some mobile home parks and a couple apartment complexes down in Houston and whatever.
Very cool.
Yeah.
So before we jump into that, because I want to talk about that and some of the details there. We talked a little bit about the lockdown and everything before the show in Hawaii. So you guys are, I didn't even think about it till it jogged my memory when I was like, oh, I'm talking to Brandon. That of all the people that come on the show, I kind of compare, I guess you would say, New York State or California to us north of the border in terms of how extreme they've been, even though it hasn't been as extreme as our lockdowns. But it sounds like Hawaii was pretty high up there in terms of the regulations and the lockdown.
Yeah, they do similar stuff to what you guys had. Like they wouldn't let anybody in for a long time, like 6 months. They just wouldn't let people in the state hardly at all unless you quarantined for 2 weeks, and it was pretty locked down in that way. So nobody really came. And then even like we still wear masks everywhere pretty much here. We're like the one state left that, I mean, now everybody's wearing masks again, but that never really went away. I mean, you're outside for a while. It was like you had to wear a mask at the beach outside by yourself. That was weird to me all the time. And that was weird to everyone. They're like, what? And they were walking around giving people tickets if you were sitting on the beach alone without a mask. And we're like, you had to come over to me. I mean, I never got one, but you had to come over to people, get in their space, infect them with your disease to give them the ticket. That, like, how does this logically make sense? It didn't make sense, but finally they did away with the needing to have a mask on the beach, which was nice.
We had there was a point definitely in Toronto where it was like if you were outside jogging, there was like the public shaming of like people looking at you like, what's going on over there? You walking or jogging?
Yep. Oh yeah, there was a lot of that. So after you have to wear a mask everywhere, then it went to you have to wear a mask if you're not exercising. So like there were stories of people like riding their bike and they stop for they just like stop the bike from moving and a cop runs over and gives them a ticket. You're just like, come on, I stopped for a second to look at something or whatever. And so you had to pretend like when that happened, you had to pretend you were working out all the time if you're outside. So somebody walks by, you're just like, doing jumping jacks or something like I'm exercising here by myself. Yeah, it's so weird.
Yeah,
thing.
well, You know what? At the end of the day, it's one of those things where, at least as it relates to real estate, I'm sure you have come across people in our industry that they saw '01 or 2000, 2001 as their badge of honor, or '08, '09 as their badge of honor, or if you go back further, the early '90s in the real estate market, commercial real estate market in the States and Canada. And it just, this is one of those things where it is a technical recession, and it's something that I think it will be a benefit to investors down the road, because they will have to have dealt with things that, they had never had to deal with in a lot of markets.
Yeah, very much so. I mean, this is when, it sucks to go through difficult times, and not only difficult as much as it's uncertain times, right? There's just no certainty. But that also trains us to be better. It makes us better people, better investors, smarter, more nimble. You get caught in this, everything's always going to be the way that it is right now. And you start forgetting that the world changes all the time. Nobody foresees any of this. That's why they call them black swan events. They're so rare, and you can't predict them. The only thing you can predict is that there's going to be unpredictable things. And so when we change our mindset around unpredictability and say, this is life. So how can I be an investor that can handle unpredictability? And how can I be nimble? And how can I be liquid? And how can I make this light and have a team? And those things forge us. And we'll be better investors because of 2021 and 2020, not worse. Yeah,
I think at least the way I saw the way people underwrote deals or are underwriting deals now, the percentage you have in reserves, has been affected by a lot of investors. And I'm talking from just, the mom and pop shops to institutional companies that we deal with, that they're starting to think a little bit more about, how levered do they want to be, and just having outs, because they don't want to be in a position where we have economic situation like we have had over the last year, and kind of be caught in the rain there. Yeah,
that's exactly it. And I think, again, hard times make good people. So it's a positive.
So on your agenda, it sounds, clearly, what was it, 3,500 units. You guys have been busy. What I'd like to actually, for listeners that don't know the asset class, we've had people that have come on the show. Before we get to the apartments, just the actual mobile home parks, especially for the listeners, half of the listeners are Canadian, roughly half are in the States. And the mobile home park it's not a particularly large asset class at all in the Canadian market, but we always have people on from the States. And I'd love to just get your, what is it, and how are the deal structures in terms of leasing as opposed to ownership, and maybe how you stumbled into that vertical.
Sure. Yeah. So there's a lot of different types of mobile home parks out there. There's RV parks, and there's combinations, and there's mobile home parks where essentially we're talking mobile home for those who really have never heard of one before. We're talking about these little houses that are typically 2-3 bedroom, maybe 1 bedroom. They're typically 10 feet wide, 12 feet wide. They have double wide, 14 feet wide, or they have double wide ones, but they're like shells that you then put little rooms inside of it. And it's typically cheaper building material, typically a flat roof, not always. They were really popular back in the 50s. They started getting prevalent here in North America, and there's millions of them, units, not properties. There's millions of people in America still live in mobile home parks, and in Canada some do. Again, they're not as popular, but they are up there, and they come across our plate occasionally. We don't buy them there, but just because it's not we don't know what we're doing there. So I'm a big believer in having a focus.
If I could interrupt you for just one second
please.
On that, I'm just curious. Are they predominantly in East and Western Canada? Where have you seen deals come up?
I've seen them all over the place. In Canada. Yeah, I've seen some. I got some in Saskatchewan. Is that that name? Yeah. So I've seen them there. I've seen some out east. Maybe 1 or 2 have ever crossed my plate. We don't get them. They're so rare, and they're also they're usually more on the RV park side, where it's somebody has a bunch of RVs and maybe they put a bunch of mobile homes on them. But they're not real great in cold weather. They do them. We buy them in Minnesota. We buy them whatever, but they just don't work quite as well in cold weather. So again, my first one was in Maine, so it's definitely possible. Maine is the cold north, about as cold and north as you can get in America.
Okay, so we're on the mobile home parks, where these smaller houses, millions of people in the U.S. are still living these. What kind of, you mentioned there's different variety of these.
Yeah, so like sometimes the owner will own the land and the homes, and they just rent the homes out. That's done. I don't like that model because mobile homes tend to break easier. They're like a cross between a car and a house. And when we say mobile homes, typically they don't move. I mean, they can move, but it's not like an RV or a motor home or whatever you call them. Do you guys call them RVs?
Yeah,
in Canada?
RV or motor home.
Okay, so. Yeah. Okay, yeah, so same terminology. So it's not like that where you just like pick up and drive it. They have to be moved on a trailer. You have to put wheels on them, and they require between $5,000 and $10,000 to move them. So they don't get moved very often, but they are movable. And so sometimes the land, again, the owner will own the land and they'll rent them, but they're usually not very good quality. They break easier. And so I don't like to own them. I'd rather have a tenant who can go and fix his own toilet for, $30 rather than me having to fix his toilet for $400 with a plumber, because knowing that things are going to break a little more often. And there's a little more, they're a little thinner walls and a little bit thinner studs and a little bit thinner everything and a little bit just not as good quality-wise as like a traditional stick-built house. So we like to buy them where we own the land and the tenant owns their own house. And the tenant, maybe they move their house in, maybe it's been there all along, maybe we buy a house, we move it in, and we sell it to a tenant, and they buy it and they own it then. And the beauty of that is that they're just paying lot rent. Like they're just paying for the right to have their house on my lot. And typical lot rent's $250, $350, $400 maybe on the high end. I think we have some nicer parks that might be up to like $600, but most of them are usually in the $300 range that they pay for the right to have their property there. Then they typically pay their own water and sewer bills. It's just like they own a house, but they have to pay to keep their house somewhere. And it's a relatively low income way. Like it kind of addresses a low income problem in America, which is just not enough housing. In fact, I was looking up some stats today and it's like 30 or 40%. Okay, I'll read it to you exactly. It was from the, where is it? One more. The National Low Income Housing Coalition. They put out a report and it said that 44% of all workers 18 to 64 are low wage workers in America. So 44% of everyone who works is making what they call a low wage. There's 38 million Americans in poverty. There's 36. So it says for every 100 extremely low renter households, like poverty households, for every 100 of them, there's only 36 affordable properties in America. Wow. So in other words, majority of those people can't afford to live. And so they're having to live multiple people in one house. So this kind of addresses that. It's like, hey, you can live here for $300 a month, or maybe $600 if you're going to pay, for the house as well. You're going to make a payment for the house, which is how we oftentimes will do it. But yeah, so it addresses that problem of low income. It creates kind of community feel. A lot of mobile home parks have a stigma because has been a lot of bad management of mobile home parks. There's been a lot of violence. When you get low income people, it tends to drive more drama and violence for whatever reason. And so we buy them, we fix them up, we make them nicer, and then we make money.
So maybe walk us through what it would look like. So you have it, you're looking at the type where you have somebody that will actually own their unit, right? And then pay you basically some right to be on that land. Is that right?
Yeah. So they own their own house typically. That's what we want. We don't want to own the house. So yeah, they own the house. They pay us $300 a month. They pay their own water bill. And the cool thing I like about these is that they don't. The cash flow can be very stable because the water bill doesn't go up and down. The sewer bill, like people stay for a long time because it's so expensive to move a home. They don't want to leave. It's their home. They're not going to leave it. Unlike an apartment where people leave every 2 years, a mobile home park, they might stay for 5 or 6 or 7 years on average. And so we get much more predictable, stable cash flow. Yeah. That I like to say is very recession resistant. And I say that like this. Let's say the market crash. We have a big recession. Yeah. And you're a millennial living in Toronto and you're paying $3,200 a month for rent. I don't know what rent is there. $5,000 a month for rent, $4,000 a month for rent. So let's say you're $4,000 a month rent. During a recession, you're like, oh, I got to tighten my belt here. I gotta save some money. Those $4,000 a month people, they're not going to suddenly start paying $1,200 a month over in the worst part of town, right? What are they going to do? They're going to tighten their belt and they're going to go from $4,000 to $3,500. The $3,500 people, they're going to be like, oh, yeah, tight times. I'm going to go down to $3,000. And everybody, it condenses from the top down. But it's not like the people paying $300 a month are going to go, well, I guess I'll go live under a bridge. Yeah. Like, they just keep paying their, it compresses from the top down. Yeah. And so I would be worried about owning a rental with $4,000 a month rents in a recession, knowing that there's who's going to rent that in bad times. Those people get stuck and they have to drop their rents down to 3,000, and all of a sudden their NOI is just in the hole and they're upside down. I like the mobile home parks because it's a much smaller number. Yeah. But let's say you have average lot rent. You buy a property where average lot rent is $200 a month, which is not an uncommon thing, and you raise the rent over the next couple of years to $300. You're only raising it $100. But what did you actually do percentage-wise to the NOI? You increased it 50%. Imagine buying an apartment, increasing your rent 50%. Like that's a huge jump. You'd be on the front page of every newspaper for gentrification and kicking out tenants. But we're talking about $100 can make a 50% difference in your NOI. So it allows for pretty massive growth in an industry where cap rates are the same as they are in apartment complexes. So if you're buying at a 4 cap or a 5 cap, you can do some dramatic increases of value add just by raising rent or by infilling, putting more units into it.
Yeah, I think it speaks to the last during COVID, a lot of the AAA A-class property that took the hit, right? That's where it first took it on the chin, because you're not thinking, like you said, of doing $4,000 or $5,000 rent for a 2 or 3 bedroom anymore. You're doing, you're going to break down to B class, and then the Bs are going to come to C. Yep. But you're right, C doesn't just, they're still around.
Disappear. They're still around. Yeah.
So, you know what, the thing for me conceptually, I've always tried to understand with the mobile home parks you're talking about, is that when you have an apartment building, say it's a 50-unit apartment building, part of the strategy is the rent, clearly. The other one is how you allocate your capital as it relates to, say there's equity appreciation, you have a capital event, you refinance in 5 years, take that money out, and play with the equity component. How does that work in mobile home parks when you're taking this kind of rent that they're going to give you because they have the lot, but you technically don't own the structures? Do you own the land?
Yeah, we own the land, and so it really works the exact same way. I mean, we treat it exactly like you would buy an apartment complex. Like, there's really no differences other than the fact that you don't have to send in a plumber to fix the toilet. The tenant takes care of their own. And we still deal with a lot of rehab stuff because we're constantly buying houses. Our strategy is actually not to jack up rent. Like, that's actually some companies. This is where mobile home parks get a bad name. They will buy a property where lot rent is $200. They will then go in and they'll jack the rent to $500, and they'll say, well, tenant, what are you going to do? You can't afford to move your house, so screw you. That's what people, and like, it's sad. I understand it's capitalism. This is how it works, right? It's business and whatever, but it still hurts. I don't like that. What I would rather do is say, hey, your lot rent is $200 a month. Okay, fine. We're raising it to $225, and then next year $250, and next year maybe $275. So we raise it over time. But what we want to buy is a property that's 80% occupied and make it 100% occupied. Because unlike multifamily, let's say you buy an apartment complex, and again, I buy apartments too. I'm not saying they're bad, but if you go and shop for an apartment right now and it is 80% occupied, you are likely paying a cap rate as if it was completely full. Okay. Because they will assume, oh yeah, you're just going to add those 20% in, you'll be fine. So you're paying actually for those units that are empty. On a mobile home park, that's typically not the case. If it's an empty lot, it's not included anywhere, even in the brokers, like the pro forma. It's not included in there. It's just like, yeah, that's not rented, so we're not including that. So we're literally buying them for the value of a 70% occupied property. And so when we add in those 30 more percent or 20 more percent or whatever, it dramatically increases the value of our property. So now we're combining slow rent raises that keep our tenants taking care of them with this idea of infill. And so combining the two together creates a pretty massive increase in NOI, which then allows us to refinance, do the same stuff, take out capital, or sell a few years later and take a property that you bought for $5 million and go ahead and sell it for 10 3 years later. It's like those are doable things.
Yeah, it's like truly accretive in the sense that you're going to actually bring each vacancy, whether it's 20 or 30%, actually value add dollar for dollar. So of that 3,500, Brandon, so that was all in the last year and a half. And what percentage of that, or how many units of that are, or if any, are apartment buildings as opposed to mobile home parks?
Yeah. So the apartments we haven't closed on yet, but it will out of the, because 3,500 is the ones that we have under contract and the ones we own. So all we've closed on so far since the last 2 years have been mobile home parks. That's like 1,700. The other 1,800 out of them, about half of that is in apartments. So I think there's 3 in Colorado and 1 in Houston that we're buying. So total maybe 700 units combined. Of all of that, and I like the apartment stuff too. There's nothing wrong with it, and it's great, and I want to do a lot more of it. In fact, it's way more scalable. This is why we actually are going into it. There are only 50,000 mobile home parks in the entire country, or North America, that are left. 50,000 of them.
Really?
And that might sound like a lot, but there's more multifamily in Houston than there are mobile home parks in the country. Well, right? So it's a pretty small number.
I was going to say in the States, I can't remember the latest stats, but it's something like 25 million units in the country or something, like because I think the actual housing units is like 50 million or something. But we were talking with Jay Scott. He was on the podcast a couple months ago, or maybe a month ago. He was talking about that sweet spot when it comes to multifamily, where he's like, the smaller multifamilies are great. You can find good property management. He's like, the big stuff, 80 plus, 100 plus is great because you can hire 1 or 2 full-time people. You can have really qualified management, and he's like, it's that stuff in the middle. He's like, it's very challenging to have good management. So
it's so hard.
Maybe on that,
we got out of it.
On that point for you scaling. So those sound to me like still pretty expensive markets, Houston and Colorado, right?
They are, but that's where everyone's moving to. And so that's why we're looking down the road, like where's the macroeconomic drivers happening, and it's in those cities. Like it's the Nashville, it's the Austin, it's the Houston, it's the Denver. And so if we can find a deal that's pretty good, I think we'll be able to, we're not buying based on appreciation, but I think we got a really good shot on appreciation because of just the population growth and the fact that they're not building enough in those areas. And so that's why we've kind of focused at the apartment side. Like mobile home parks, we have our criteria for location, but it's not as strict as apartments, because like even in a smaller area or an area that's not massively growing, there's always going to be low income people that need a place to live. And so I'm not worried about that. On the apartment side though, like I want to make sure that if we're buying a 500 unit apartment building, I want that area to be going up in value, because I need appreciation to play a piece in the growth. Versus mobile home parks, I don't really need appreciation to play as much of a piece. That's kind of more of a cash flow game and a forced appreciation game. So
it's challenging too. I mean, if you have investors, you at the end of the day, we talked about this last time. Cash flow is crucial, and you don't want to just a bank on appreciation in any way. But the reality is, when you have investors and you're showing them some exit cap rate, something that influences IRR, you have to factor that in, and hopefully you're in a market where you can justify that and illustrate that to them.
Exactly. Yeah. So if we're projecting, let's call it 3% per year appreciation, if we're going to say that, like I would feel comfortable saying that in Houston. I would not feel comfortable saying that in Cleveland. Right. Like I'd be like, that would be a stretch. And at the end of the day, like, we're only as good as our last deal. If we start doing crappy, like, giving, 3% IRRs because we underwrote a 5% per year growth, and really we're in an area that's losing 2% every year. That's a problem. So anyway, that's why we're betting on the better markets.
You don't want a 100-unit apartment building in Buffalo with a hockey stick graph for appreciation. So what is your call it perfect apartment avatar in terms of unit count, some of the economics, maybe some of those macroeconomic trends you're talking about?
Yeah, I mean the biggest thing that we look for is we're looking for the population growth. Like we care a lot about that. We care about a decent amount about the landlord-tenant laws of the area. We'd like it to be a little bit easier. I don't want to buy in California or Hawaii for those reasons. I mean, everything's got a price, right? If you buy a good enough deal, maybe I'd survive California, but I prefer that. Unit size, anything over 100 lots. I mean, 100 lots or 100 units, depending on if it's an apartment. Well, I don't want that middle spot. It's just too hard, right? I want to be able to have staff and have people. I want a clear path for forced appreciation. I like value add. I'm not saying I want to buy a completely junker property. I like to have cash flow today. We call them cash growth deals. Like one word, cash growth. It means like you get cash flow from year one. I'm not doing development. I'm not doing projects that won't make any money. I want to make money from day one, from year one. But I also want a clear path for growth in value that's not dependent just upon, let's do 3% per year for appreciation.
Absolutely.
Right. So yeah, the property we bought in Houston, or buying in Houston right now, there's 530 units, but 300 of them have been completely remodeled and are achieving a way higher rent. So we have a very clear path. Okay, the other 200 or whatever 230, we're going to remodel them, and now we can get the same rent that these other 300 are at. So I don't have to guess on like, I wonder what will happen if I remodel this unit. So we have a very clear path towards growth, and it's in a great area. It's got all other benefits to it, but yeah. And for me right now, bigger is better. Because we can raise money better than most people can because of my position, in the world of BiggerPockets and everything. So it takes less work to buy a 500 unit property than it does to buy a 12 unit property. I don't know why, but it's just the way that it is. And so I would rather buy a big deal since I can afford it than buy a little deal. It's just way more bang for way little effort.
Yeah. So the Houston market right now, where would you guys be on a per unit? Are they in the 200,000 per unit range? Are they?
Generally in the 220,000 range. We're buying ours at 118, and so like we felt pretty good about that. Wow. Now again, it's a larger deal, which you can tend to get a little bit lower cost per door, but yeah, we're buying at like 118, and so I think we got a lot of room for growth.
Our at the brokerage house I work with, I think we're on average now, Toronto's is just kind of gone insane. We're at 330,000 per unit.
Dang,
and those are the big, like, those are big ones. Those aren't like, it's pretty crazy. But yeah, I mean, that's good to hear that there's still deals, like even in good markets in Texas, because I totally share your view on the landlord tenant or the regulatory framework, because like you were saying before, at the end of the day, there's extremes, right? You don't want to just jack up somebody's rent 3 times, but you also don't want to, with rent stabilization in New York, rent stabilization in, I believe, DC and California, 1.2% a year it's kind of a joke. Like it's to me, and I won't get into it, but it's fairly paternalistic to say that people can't contract on their own. It's kind of like consumer protection laws. Everybody all of a sudden is a little old lady that can't help herself, which obviously we got to look out for those people. But anyways, so these deals, I want to talk a little bit about how you started in terms of the structure of how you're raising capital for these deals. You mentioned the BiggerPockets, because if these are syndicated or private equity deals, it seems like you're using, I guess, 506C or where you're able to kind of advertise. Maybe you could talk a little bit about that.
Exactly. Yeah, so we got the 506B and 506C options, right? I don't know. Do you guys have those in Canada?
We call them national instruments, but they're very similar.
Okay.
There's, credit investor, family and friends, all that jazz.
Exactly. Yeah. So most investors start at the 506B level in America, and family and friends, they start there. We kind of just started with C because of my position on the podcast and having a big platform, and I got 250,000 followers on Instagram. And so I have to be able to advertise, and so we went 506C. It means we can't take unaccredited money or non-accredited money, but that's okay for now. Maybe we'll figure that out in the future. They have things called the Reg A's, which allow for both, but I probably won't go that route.
Was that kind of the Grant Cardone? Like that's the road he took, because there was like, I think it was as low as like $5,000 or $10,000.
Exactly.
Okay.
And here's why I don't want to go Reg A. Here's the truth. Like, Grant Cardone got sued. I don't know if you knew this or heard about it, right? He got sued. He got sued by a guy who put in $10,000.
Yeah.
Like, he didn't get sued by the guy that put in $1 million. He got sued by the guy who put in $10,000. And like, I'm sure that I don't know where the lawsuit ended up. I don't know much about it other than that I heard about it. And they probably will settle or did settle. I don't know. Mm-hmm. But that's the annoying case. When you bring in uneducated money and unaccredited money, you get the people who are like, well, he said I was going to make 15% every year, and I only made 3% this year. And he's like, yeah, I said IRR like over time. And there's, well, what's IRR? Like that's where you get those people. The more money people put into my fund, the less questions I ask. Yep. It's just a phenomenon that I love. And it's the people that put in 30 grand that are asking all the questions, and the people that put in the million are like, where do I send my money? Yeah. Which is great.
You keep sending me emails. Can you stop sending me emails?
Yeah, exactly. So so we did 506C. We were on the first I mean, on everything we've done has been 506Cs. We did funds for we do funds for the mobile home parks because the average price of a mobile home park is $3 to $4 million. We've steadily increased that because we want larger and larger properties. And so now, like right now, our average this quarter, I think, is like 7. But they're still smaller deals. And so I don't want to just and plus they're mobile home parks, which people view as a little riskier. And so I don't think they are, but people view them that way. So if we package multiple ones together, everyone feels better and it's a bigger amount of money and it's less paperwork. So we typically put between 3 and 7 parks into one fund, probably average of 5. And for example, our newest, we raised $19 million on Fund 4. It was a $19.5 well, it was a $20 million raise. We shut it off and money has been trickling in the last few days and we're at 19. I think we're just going to call it good because that's about what we need to close on the 5 or 6 parks we have ready to close. So that's how we do that side.
So I'm curious. I was listening to, I can't remember what podcast now, but it was talking about the funds, and I was explaining it to a colleague of mine that there's callable capital. There is capital where you actually have it fully invested, and then you better have they actually give you the money, so you better have pretty good deal flow if you're going to have money sitting somewhere. How do you structure it in terms like do you have a commitment that they have to actually give and then it's called? And then the second question, when you actually have investors that do that, do you have a percentage allocation that they make, or is it kind of first come, first serve?
So we do a little bit of a hybrid, but basically we raise all the money to begin with and we just have good deal flow. Yeah. We are very meticulous on our outreach, on our broker relations, on our off-market search. We're very detailed and very systematized in it. And so, for example, we get 10 point whatever % of our offers accepted. We just get that. We just so we're like, okay, so we made 74 offers or whatever it was, or 76 offers, I think, 74 offers, something like that in quarter 2. And we got 7 offers accepted. And so we just know that we're pretty straight when it comes to our funnel, and we treat it very much like a business. So I feel like our deal flow has been pretty predictable from the beginning. Now there have definitely been moments where we're like, okay, well we got $6 million sitting into an account right now and we don't have any properties. This is we're just losing money right now. And we're draining, our investor returns are going to drop a little bit, but it's not as substantial as people might think. Over a 5 or 7 year time period, if you have money, it smooths out. If you have money sitting for 6 months doing nothing, it might drop your IRR by 0.25%. It's not the end of the world. That said, that hasn't really happened. We just we typically, when I say hybrid, what we kind of do is we raise in chunks based on what we need at the moment, right? So or what we think we're going to get. And so it's kind of we'll have a $20 million fund and then we'll go raise a bunch when we launch and we'll have 5 or 6 or 7 million with trickle in. And then we'll start using that. We'll start buying properties. And then it's okay, we're getting kind of low. Better put on the gas again. And then we'll go and I'll talk about it on my Instagram and on my podcast. And all of a sudden more money comes in. And then we pull off the gas. And so we can throttle it based on what we kind of need. And that's been really helpful. The downside is that means we're typically raising for blind funds. It means that we can't say, here's a property, this is what the numbers are. Instead, it's this is the team. Trust us. We're going to take care of you. And that's a little bit harder to sell. So it takes a little bit longer. But as we build a track record and as we get more and more deals, we start going full cycle. I think that'll be easier. So we've raised $75 million in the past 13 months or something like that. And so, thanks. Yeah, it's been crazy, but I think that's just the beginning of what we could do because now we're looking at selling our first fund and we're moving into the next. And so as we get that track record and we say, look what we did over here, it's going to be easier and easier to be able to have people trust us. And then the apartments are a lot easier in terms of this is the apartment. And those are one-off deals that we can explain.
I'm reading the Hands-Off Investor, and we had Brian on the show, Brian Burke, for anybody that wants to look it up. And he said, you said trust. He's the fund is the trust vehicle. He's that's what the fund is. The building, if it's a syndicated one-off, you can touch it. Here it is. But like you said, it's here's our investment philosophy, here's our track record, here's the team, trust us. So on that point, so 75 million that's raised for that, and you're talking about now potentially selling the fund. So the fund, would that be on the mobile home side? Yeah,
it's just our first one. We've done 4 mobile home parks funds. So our first one was small. It was only 5 $5 million, I think total we raised. Maybe it was 4. And then we bought, $8 million worth of real estate. And so we're looking, or I don't know what it was, somewhere in there. And so now we're looking to sell that one. In fact, we should have decided for sure. We're not 100% committed to it because I think there's still a lot of meat on the bone. We're only selling it so we can say, look what we did. We've got a track record. We've gone full cycle now in our first fund. Now we can go to the next level. But I'd rather not sell. I think we can make more long term if we don't. But I need the reputation.
Yeah, I'm the same way.
Grow,
True real estate guys. No, never sell. So
yeah, I know. I'm like, I don't want to sell. Like, there's so much there, and I think we're in such a good point right now in the market to buy.
So when you the logical buyers for that, so it would be kind of a portfolio sale of whatever assets are rolled up in that fund, and then I assume it would be the same down the road for the apartments. And on that note, just on exits, when you talk to investors. For instance, stuff that you're purchasing, say in 2021, 2022, when you talk to investors, and I'm sure you get the question like everybody in our world gets is, what's the exit strategy? When do we realize a return? What constitutes a capital event? And how do they get the return on capital? What do you kind of, what do you do with these funds on the apartment side now?
Yeah, on the apartment side, I mean, we typically say 5 to 7 years is our expectation, but I always make the disclaimer: I don't want a thing I said 5 years ago to dictate when we sell. I want performance to dictate when we sell. So if that means that we're going to do it in 4 years, or 7 years, or 9 years, or 5 years, if you can't be flexible, then we don't want your money. And we're very blunt about that. Like, we want to work with people who are flexible enough, because it's all about managing expectations. If I said 5 years and then it was 6, and then you get a bunch of mad people. But if I said 6, they'd be fine. It's all expectation management. Well, it's kind of like you were talking, I don't know if it was before the show or at the beginning, the badge of honor of going through certain recessions where some investors won't invest with people if they haven't gone through, some sort of financial or economic calamity. But it is one of those things with, if you said to investor, I don't want something 5 years ago that I said in 2015 to dictate, and COVID happens. And now I have to, commit to that 5-year deal. Yeah. Yep, and so I'd rather give myself some flexibility. So if on the apartment side and on the mobile home park side, both of those we say 5 to 7, but we're flexible. Be flexible with us, and let's just make sure we're getting the maximized return that we can get everyone the most amount of money. Because that's what matters.
Awesome. All right, Brandon, I want to shift gears. Time flies when we're chatting, and I want to talk a little bit about the book. You mentioned, correct me if I'm wrong, mid-August.
Yeah. I think it's mid-August, 19th, 18th, something like that comes out. Yeah, I should know that exact date, but it's moved a few times. So for listeners, a little bit of the background for the book. I know I assume it's under the BP brand. You guys always have great content, great books. I'm sure you got some amazing Amazon stats for all those books. But yeah, give us a little bit of a background on it. Yeah, so it started with Brian Murray, who's my partner in Open Door Capital. We invest in the multifamily together. Us talking about how there's no book that we thought could be like the definitive book on just multifamily, like residential multifamily real estate. And so we started talking about, well, maybe we should write one. Maybe we should talk about this. He's written one on commercial real estate before and included apartment stuff, but it was just more on general large commercial. And then I've written obviously like a bunch of books on residential, but it was very wide. And so we thought, how do we go a mile deep on one topic that's very popular right now is apartments. And as we did that, we realized we couldn't do that because multifamily, when I say multifamily, some people think duplex and some people think 300-unit apartment complex. And the truth is they are very different, right? And so where do you draw the line? And at first we're like, okay, well, 4 units and smaller is residential and 5 units or greater is commercial. Okay, well, who's syndicating a 5-unit property? No one is, right? Yes, the financing is a little bit different, but the game is the same. If you're buying a 3-unit or a 5-unit or even an 8-unit or a 12-unit, it's all kind of the same. So where do you draw the line? And I'm like, I don't know. But at the same time, you could syndicate a duplex if you wanted to, and you could have a team that buys duplexes. So it's not about unit number. And so we define it as approach. There's 2 approaches to real estate. There's small multifamily real estate approach and there's large there's a bunch of definitions we've defined here, but the one I like the most is if you know your tenants' names, you're probably a small multifamily investor. If you don't, you're probably large, right? Because if you don't know who your tenants are, it means you've got people in place, you've got systems, you've got teams, you're probably raising the money for it. You're probably got quarterly meetings and you're issuing distributions and all that stuff. That's the large game. So we wrote 2 volumes that are like, I wrote most of the first one with some input from Brian. He wrote most of the second with some input from me. And so volume 1 is on small deals, like how to buy that first apartment. I mean, the first, duplex, 4-plex, 8-unit, 20-unit, how to self-manage or find a local property manager. And then his book is more on like, how do you build a team? How do you syndicate? How do you raise money? What's a mezzanine debt? What does that mean? Like all those things that are on the larger scale. And so we're just launching them together at the same time, because most people are probably going to end up going from book 1 to book 2 over the course of their career. So
that's probably the direction you want to go. And I really I like the breakdown of that, because it kind of gets to the different markets that we have. Like we were just talking before, very expensive markets, whether they're in the States or Canada. When I hear somebody bought X amount of units for $5 million, and that gets you, like you were saying before, like a 6-unit in a certain market. And it's like, well, raising $5 million, you could definitely syndicate a $5 million deal. You're raising, whatever it is, a couple $1 million worth of equity. Whereas, that size unit deal would be like a couple $100,000 in some small market. So I like that. That's really cool. So
correct.
The book itself, the volumes, it sounds like kind of the progression for each one is the same. Like, are they structured relatively the same so that they're kind of a companion?
Yeah, pretty similar. So you walk through all the basics that you'd get. So how to find, how to build a business plan around it. Like what are you gonna do? How do we make that real? So I'm a big believer when I write books. I love to make things real for people. So not just theory, but like let me show you how this plays out in real life. So for example, I have a chapter in there called like what's the title of it? Basically like financial freedom in 5 years, I think, like that. And it basically walks people through let me see if that's actually correct on the title. I know we changed titles a little bit. Yeah, financial freedom in 5 years. And it walks through a concept that's a little bit complicated, but the idea being, a lot of people are overwhelmed by the idea of owning a 20 unit or a 50 unit. It's like, that's so many units. I'm just getting started. How do I do that? I'm like, well, don't worry about the 50 unit. But it doesn't mean you have to be stuck on single family. So imagine you bought a duplex this year, and I walk people through the story. Like, you bought a duplex. Here's what it makes. Here's how much it brings in. Wow, you're making $300 a month in cash flow. Good job. Like, but that first deal is so important for forging your identity. And then next you buy maybe a 5 unit, and then maybe a 10 unit, and then maybe a 30 unit, and then maybe the 50 unit. And so that concept really shows you that in 5 years, you could get to like $5,000, $10,000, $15,000 a month in passive income. And you just scale up slowly. And so I could tell somebody that, or I could paint it into a picture. So like, that's an example where I did that and then walk through chapters, obviously, like how to find deals, how to fund them, off market, on market, how to finance them, some creative strategies. I spent a lot of time talking about the different types of multifamily, like the monster house, which is like the single family that's been converted into like, the Frankenstein, exactly. They just add on units here and there. Like, how many of us have those? Yeah. I have a few of them still, where they're like, they were not meant to be a multifamily, but they've made them there. And I walked through the pros and cons and like how do you deal with that? Or the side by side. Like, I love side by side duplexes and triplexes and fourplexes, because the water meters 100%. Can be separated usually, so you can shift the water onto the tenant. Like, that little tip, like things like that. Versus a up and down duplex where the water meters are all the water lines are connected together, and it gets really difficult to separate. So there's a lot of like specific about that.
Yeah, that's very cool. It just kind of got me thinking too. Like, we don't have cost seg here. I don't think you're actually allowed to. But separately meters is like, it's huge, right? When if you can get everything where suddenly your expense ratio goes from 50 to 30%.
Exactly. Yeah. And there are property types that allow for that easier than others. And there's rubs and there's all that like that you can throw in there. But yeah, it's like knowing those little intricacies that can make or break a multifamily. That's what's kind of the goal.
You know what? I think it's not cost seg. It's ratio utility billing is RUBS, right? Something like that.
Ratio. Yeah, I think that's what it stands for. Yeah.
I know there are certain states allow for it,
and they don't do that.
Like certain ones. Yeah. So
interesting.
That's cool. Different building style. It's funny where you talk about scaling. It's so true. It's so much easier or at least, I'm a visual person. So to me, stories are the visual words, and you kind of conceptualize it. But it's so true when you come to somebody that says, hey, a 30 unit, until you do a 30 or 10, 15, whatever it is, you don't realize that it's actually less of a headache, because then, you can have support. Whereas you buy that 1 or 2, it's like, it's more of a headache because it's all you.
You're doing it.
Very cool.
Yeah, I know. I bought a condo, a single condo here in Maui recently. That one condo has been more work than 3,500 units combined. Like, it's insane.
Yeah.
It's insane that I'm saying that, but one little condo is more work than 3,500 units and dozens
100%.
plus properties.
Because like you're like, what did I do Tuesday? For some reason, I was on the phone with a utility company for 2 hours.
Yeah. Yep, exactly what that is. It's constant problems and contractors not showing up. And of course, it's not big enough for me to just have a team to take care of the whole thing. So I just got to do it. And I'm like, what am I doing?
Yeah.
Like,
And
this is
you know,
stupid.
it's where you talk about kind of growing to that, you know, you forge your identity to that. I think it's very much like a startup company, and where a lot of times the CEO or the founder of the company, although talented and we're in basically integral to having that company become something, may not be the best person once it's an enterprise as the manager, you know, where you have more people that may be more systematized or system oriented. But that's really cool. Yeah, it sounds good. So we'll take a look out for that. And if, you know, we release this after that, we'll put a link up to it. So I just I want to be respectful of your time, Brandon. I just want to let listeners know for Open Door Capital, and I'm just curious personally, what do you tell people that are interested, want to learn more, want to see what you're up to, and like you said, who is the team and what is the investment philosophy? Where should they head to?
Yeah, so we do something kind of different. So what we do is we go to an intersection. If you want to give us money, you have to put it in a briefcase, all cash. We go to an intersection, we cross the busy intersection, you drop the bag, we drop the cash. You drop the cash, we give you a little bit of a piece of paper, and we're all good. Just no cops.
Know my cousins. That's how we do it. Yeah.
Exactly. Yeah, you got to like tip your hat twice. That's how we know it's you. Yes. Yep. That's it. ODCfund.com is our website. We put everything on there. ODC Fund. Which I probably need a new website because now we don't just do funds. So now it's like ODC Fun. Maybe it'll be ODC Fun.
You're back
Have
at the
fun with ODC.
GoDaddy page.
Yeah, ODC Fun. Yeah, exactly. Yep. ODC Fun. We put a lot of stuff there. I'm super active on Instagram, and so here's an interesting point for anybody listening to this that wants to eventually raise money, is that I once had an investor say to me, the reason I invested in Open Door Capital is because of the way you talk about your wife, and that was such an impactful statement for me because I not like patting myself on my back here. What I'm saying is like people are not investing in Twin Oaks mobile home park in Ohio, like whatever. Like they're not investing in that. They don't know about that. They're investing in my ability to do what I say I'm going to do. And so you are marketing yourself every second of every day and every interaction that you have in the public. So the way you promote, the way you talk about your family on Instagram or on Facebook, and the way you comment on other people's stuff, all of that is showing the world what kind of person you are. Can you be trusted? And 5 years later, that people are going to look back and say, like, yeah, I've been following you for years online, and I respect the way you do business, or the way that you respond to people, or the way that you're kind, or the way that you're smart. So anyway, that's a big thing. So anyway, I try to put my life on Instagram in a lot of ways, which sometimes gets me in a little trouble, but it's good. Like when, it's been
I'll say this,
it's been
Brandon,
good though.
just say, you know, I'll pat you on the back so you don't have to do it. But like we've, you know, going back to the first time we spoke on BiggerPockets, like, I don't even know now, five, whatever it is now, but
forever ago,
it comes across authentic. And I think a big thing of it too is I've noticed, you know, much smaller scale with myself, the other pieces, they can tell how much you love real estate. And you can't fake that. It's really hard to. So if I look at your page and not number one, it's authentic. And say you're the less, you're more logic and less emotion. What comes across is that you obviously really give a shit about real estate, because if you didn't, you wouldn't talk about it all the time. So I think it's important for the principal that you're investing with to love the asset class. Like they want to eat, sleep, and breathe real estate.
Agree. Yeah, I totally agree. I have a lot of people say like, yeah, I don't even like real estate. I'm just in it because it makes money. I'm like, well, that's cool, but like, man, I love this game. I love every piece of it. It's fun. Even dealing with nasty contractors. Like I'm like, this is a game, and it is a lot of fun to play, and it's got real high stakes. But yeah, I'm
beautiful. So before we shut down here, BPCON 21. I know it's gonna be awesome. Fingers crossed, everything's going in the right direction. New Orleans, October, oh my God, 4th now. I'm trying to.
Yeah, 4th and 5th. There's like a preview day on 3rd. if people want to go to that. I think those might be sold out.
Some
Though,
pretty
anyway,
pretty amazing speakers
fourth
on the center stage. Hal Elrod, I think, is on there. I am speaking.
You're speaking, right?
I'm on a rental.
What are you speaking on?
I think we're talking, rental.
Ooh, nice.
Real estate. But yeah, sorry, I was talking the center stage, like Hal Elrod and
yeah. Oh, you know.
But yeah, no, there's a bunch of really cool speakers I've kind of just reading through before we jumped on. So that's really cool. If anybody's interested at all in learning more about this, we were there. Was it now 2 years ago, right? In Nashville. That's right. I was like, why were there? I was picturing guitars. Like Nashville.
Yeah.
Awesome.
Yeah.
Okay.
Yep. Awesome, man. Well, yeah, I'm excited for it. It's gonna be a lot of fun. Hopefully hopefully COVID dies down a little so we can have a good time.
Absolutely.
But we'll see.
It's gonna
be a good time no matter what. But
yeah,
maybe a good time with masks.
We'll be there. Well, Brandon, thank you so much for being part of Working Capital. And like I said when we started, really appreciate you giving your time and your insight.
Oh, thank you, man. This has been a ton of fun. So appreciate you.
Right on.